Well, gold is money. Gold has been money for thousands of years. Banks recognize that they can't trust other central banks. We're back on that road to more inflation, more debt, more government spending. Things are getting increasingly out of control, and politicians are not talking about reforming the situation at all. They're advocating more government intervention, more spending, more debt. We'll levy the taxes in the future. We'll spend the money now. That's the biggest lie in the book. The end game has been revealed to us.
Dr. Mark Thornton, Economist and Senior Fellow at the Mises Institute. It is a true pleasure to host you on Palisades Gold Radio today.
It's a pleasure to be here. Thank you for the invitation.
Excellent. Excited to hit the ground running, talking gold. The metal is up over 150% since the year 2022, and a bit longer term, up over 1,500% since the year 2000. Incredible returns. Oftentimes we hear it's a bedrock, it's a metal that will only keep up with inflation and not do much more than that. However, the last 25 years, or the last 50 years for that matter, we have seen something entirely different than that. So, Mark, I would love to hear from your perspective. What is gold? What is the role of gold in this financial system? And where are we within the longer term cycle for gold?
Well, gold is money, basically. Gold has been money for thousands of years. And it's really only been in the last 50 years that governments have forced their way into the process and substituted currency, fiat currency, for gold. And it took them a long time to wean us off of using commodity money, gold and silver and copper. But eventually they did it. And we've been on a fiat paper money system now for over half a century. And it's caused all sorts of problems. And, my study historically of gold and stocks is that gold's held up very well over the last 50 years. The last 25 years, certainly, it's kept up with the leading stock markets in the world. And that's not a good thing. That's a sign of trouble. That means that the government has been spending too much. It's been borrowing too much. And, of course, it's been inflating the currency, devaluing that currency that it substituted in. So, my outlook is not unlike other people inside the industry, including central banks. Even central banks recognize that they can't trust other central banks. They're all in this game to inflate their currencies, to provide for more government spending and more government debt. And there's no real let-up in sight there. So as long as governments continue along the path that they've chosen, and unless we stand up and do something about it, the conditions in the gold market are going to continue as we've seen, which is higher prices for gold and higher prices for silver. And then just recently, as governments have been losing more credibility, as central banks have been losing more credibility in marketplaces, well, those metal prices have been skyrocketing higher. And, my outlook on those metals is going to continue to look for higher and higher prices until, what they've done in the past is said that, well, they'll reform themselves. And they have cut back, at various points in time when it looked like the currency value was going to just pitter away very quickly. So, of course, we're going to be on the lookout for that in the future. But right now, it's full steam ahead at all the central banks and all the governments around the world, the United States, the Europeans, certainly, the Japanese, the Chinese. Everybody is just in a runaway situation.
You're opening up so many threads there that I would love to pull, Mark. But let's get started with this one, central bank buying. Do you believe this is really the main driver behind the recent bull run we have seen in gold, this mistrust or distrust in the US dollar?
Yes, it's definitely, we can link that with distrust of the U.S. dollar and distrust of government bonds in central bank portfolios. So I think that they were really responsible for kicking off this big boom that we're seeing in gold. But that message is spreading, and it's been spreading fairly slowly so far. I think that if you talk to the man on the street, they would have no idea what's going on with precious metals right now. They get limited information, and they check their 401k once a quarter, and everything seems to be okay. So I think that stock markets and the AI boom that we've seen, and the fact that stock markets are at least inching higher all the time has kept people from really looking at the situation seriously. And I don't think they're going to look at and consider precious metal investments until they see their stock portfolios falling.
So from the perspective of the man off the street, or, the classic cab driver indicator, you believe we're still very much early in this bull run in precious metals?
Well, in terms of time, I mean, it's been several years since gold last bottomed in price around $1,000. So we're up $3,000, which seems remarkable, right? And so there's a long time span there. There's been a big move up, and a lot of people are very nervous about, have we reached a top? And, when we got to that $50 silver level, everybody was very, very nervous. A lot of new players in the market, growing pains, etc. But I really think that we're still very early in this bull run of gold and silver prices, just because of the lack of attention. There's the amount of gold and silver in people's portfolios is very small. It's very tightly controlled among, stackers on the one hand, central banks on the other. It's only very recently at all that investors have come into purchasing gold, and even much more recently into purchasing the stocks of precious metal miners, and then of course the junior miners and the explorers are just now getting started. So historically speaking, at least, all the signs point to the fact that we're relatively early in this process. And what's going to bring into real questions is when politicians admit that there's a problem and are searching publicly for an answer. In other words, they're not trying to manipulate something behind the door, behind closed doors, but they're actually publicly speaking, and there's a public debate about price inflation and about why is gold $4,000 or $5,000 or $6,000. That's when we might get a little cautious because we've seen that in the past. But right now there's no talk amongst politicians. They'd rather not talk about this subject.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. Yeah, their incentives are, of course, very much in place to not talk about it like you outlined there. You mentioned some historical, reference. I would love to talk about historical parallels for a second, because as you outlined earlier, the time frame that we're in, the last 52 years, what is it exactly, is incredibly unique in the sense that we have a fiat-denominated economic system, one could say. Are there any historical parallels that we can draw from and learn lessons from how this immediate future for us might look like?
Well, in the immediate future in terms of them pulling back and reforming themselves. There has been, at several points in time, I think the big run-up in gold prices and silver prices in the early 1980s is a good example where, obviously price inflation was having a tremendously adverse effect on the general population in the United States and around the world. So these are global phenomenon. These are global marketplaces. Governments tend to act in unison. And in the early 1980s, we had lots of reforms in the United States initiated by President Jimmy Carter, Chairman Volcker at the Fed. In Congress, they passed the Monetary Decontrol Acts of 1980 and 81. So they were talking about things, they were implementing policies, and they were implementing legislations which essentially, killed inflation. I mean, it practically killed the American economy and the world economy at the time. But that was a big pullback in precious metals, and we saw a new period of true economic prosperity. Countries like the United States and Canada and Britain all recovered substantially as a result, and we saw eventually big economic reforms in places like China and the Soviet bloc and India and so forth. And so even though we didn't get a return to the gold standard that we had hoped for at the time, just that pullback, just that reorientation, that reform efforts that took place unleashed a tremendous period of prosperity. Now, we're back on that road, to more inflation, more debt, more government spending. Things are getting increasingly out of control, and politicians right now are in no mood. They are not talking about reforming the situation at all. They're, advocating more government intervention, more spending, more debt. And so we're still very much on the wrong track, which is why I don't think we're in any danger right now of seeing pullbacks, substantial pullbacks or complete stalls in the market for precious metals to be concerned with. But ultimately, I think the world is much more serious right now about a permanent return to a gold standard. And I think, central banks making gold the preeminent reserve for central banks, and Tether oriented itself more towards gold, and the recognition amongst the two leading superpowers, economic superpowers, well, three of them really, because Russia, China, and the United States are all recognizing the importance of precious metals and strategic metals and things of that nature. And, the rise of the silver stacker community, the rise of the gold stacking community, people putting themselves on a personal gold standard, where they're saving their money in precious metals, and they're investing in their retirements in precious metals. It's not just a trade. It's not just a fad. These are mental, ideological reorientations that are taking place. I'm hoping for a permanent, return to the gold standard, and I see that as a distinct possibility.
Yeah, that's actually something I would love to talk a bit more about, that possibility of that actually occurring. I recently had a chat with Matt Smith, who introduced me to this idea of the last bull market, that this bull market that we're in for precious metals might be that last big run into a revaluation or even remonetization of gold. Is this an idea that you think has any merit, that this bull market that we're in might actually lead up into this revaluation?
Yes. I mean, I think that is a genuine possibility. I think it would come with tremendous political upheaval as well. I certainly see the United States, for example, being a less politically stable nation I think that the stability of China is very much overrated because they have such a strong centrally led government. So I think that this possibility of this being the last bull market in gold and then really re-switching back into a precious metals monetary system is very real. And I think the emergence of cryptocurrency is actually an important ingredient in all of that, because money becomes less of a state-regulated, state-run institution, but more of a private institution with privacy and private property. Those are really the two key elements of money rather than currency. Money is private property, and it involves privacy, so that all transactions are private transactions. It's not something that's overseen and regulated and looked after by the state, essentially. And so I think cryptocurrency and the fact that precious metals can be kryptonized, essentially, in the current environment, I think that that's a key element, and I think that it's also a key element that governments around the world, the European situation, the Japanese situation, in the UK, the United States, the leading countries, Germany, I think that in the leading countries, there's a lot less political stability, and that can either result in a breakup of some sort. It could result in wars as well, which would be a tremendous negative. Or it could be that politicians recognize that if they do want to hold together their system, that they're going to have to reform it in a fundamental way. So I don't know how long something like that would take to actually be implemented, but I do see signs, some very strong signs that suggest that we're clearly headed in that direction, that the end game, in some sense, has been revealed to us, and that revelation in the form of higher prices and economic instability. I mean, we've had a long period now during the Fiat regime of declining interest rates and relatively stable price inflation levels. And, that I think is coming to an end. I think we've turned the corner on this idea that interest rates are going to fall forever. And I think we've turned the corner on the idea that CPI levels are going to be 2% exactly forever. And once, another sign of this progress towards a return to a gold standard is going to be when government bond markets start to come unglued. So when we see the Japanese government bond, devolving as we're currently see it, as we see the financial situation in the United Kingdom becoming totally unglued and politically unstable, where we see the the German economy and the German government, not having any good solutions except more military spending. And then, as I've already discussed in the United States, a lot of these countries are really at a tipping point, and their government bonds are going to be the signal. Even if a small sign would be when the Fed cuts interest rates on, I think it's December 10th, and what we see going forward from there in terms of the 10-year government bond in the United States. Typically, what markets are going to be expecting is that the 10-year rate is going to decline over the next several months as a result of those cuts. If we don't see that, I think that's going to reinforce this point that we're already in the process of these government bond markets losing their magic, so to speak.
You mentioned this concept of kryptonized gold. And of course, we've heard before that the BRICS is floating this idea of a settlement currency that would be partially backed by gold, partially backed by local fiat currencies, and it could also be kryptonized in a sense. Do you think if this were to go through, this could kind of force the West, force the United States to perhaps also take this step into a partially backed government currency?
Well, I'm hoping that that's the case. I'm not sure if we're ready for that in the United States in the short run, but I think in the longer term, you're going to see experimentations on this. And I've been talking for the last several months, especially as the price of silver started to go close to $50, that the precious metal markets were entering a phase of growing pains. When we left that period where it was just industrial demand and central banks and silver stackers, and then all of a sudden, as the price rose to record highs, we started to get investors into that market, and then that market immediately experienced growing pains with backwardation and shortages in the marketplace. And so I think what we're going to see as a result of these growing pains is something of a realignment in these marketplaces. And I think that evolution in the Western markets alongside the evolution of BRICS and precious metal markets in the East, I think, it's hard to predict what's going to happen, but I think the evolution of what's going to happen is going to be a collision of those two East and West institutional factors where the Western markets are failing. They're controlled, they're manipulated, and it's a number of small players in those marketplaces, and in the East, where they're trying to open up, where they're using those markets not to control them really directly, but they're using their control or their influence over those markets to expand their general influence and to expand their trade and those sorts of things. So that collision, it's very, very hard to predict when and what's going to come of it. But I think just recently, within the last few months, those growing pains that we've seen in the Western marketplaces are a sign that things are definitely going to change. And I think that you have to include the crypto factor in those changes, and the fact that, China is going to is interested in spreading its influence. A lot of other countries are very interested in getting out from underneath the monopoly control of the United States, the dollar, and those sorts of things, the trade dollar, the dollar as a reserve asset. All of these things are colliding together. And so what comes of this, I think, is very exciting, but very unpredictable as well.
Very exciting, but very unpredictable. Well understood, Mark. I would love to talk about Austrian economics for a second. Almost misspoke there. And because, of course, that school of thought is very closely aligned with the thesis behind gold. So how would you say, Mark, that Austrian economics is mostly differentiated with Keynesian economics, or even post-modern Keynesian economics, what, for example, the Federal Reserve employs to make rate cut decisions?
Well, I mean, they're completely different, really. Keynesian economics is a state ideology where the government is controlling, influencing, where things like savings is a negative and where government spending is a positive. And really, government spending is a cure-all for everything. And government control of markets, regulating interest rates, is preeminent in the view of Keynesian economists and the Keynesian ideology in government completely across the board, across all governments. There's virtually nobody who really disagrees with this. And Austrians take a very market process-oriented view of these things that says, that the market should be determining what money is. And money should be a commodity. It should be private property, and those sorts of things. And the interest rates, as one of the most important signals of all in the overall economy, should be obviously controlled by markets. And so, a lot of our problems in the modern economy are directly tied to that. And, so besides just inflation of prices, two of the most important problems in what I've called the 7 deadly economic sins are the business cycle and the inequality of income and wealth in modern Western economies. And the business cycle is driven by interest rates. When the central banks lower interest rates below what the market would choose, it sets off an investment cycle. It drives asset prices higher, and it creates a boom in the economy. And, Keynesians see that as just the normal thing. And very often, in retrospect, what is clearly a bubble in the economy, Keynesians were thinking, well, that's just normal. Those are just normal conditions that we want to try to maintain. But we're almost always, in my work, my own research and publications has pointed this out. In my book on the skyscraper curse, I show that for the last 100 of years, Keynesians have been, proclaiming normality and economic plateaus and things of that nature. But in retrospect, of course, those were all just economic bubbles that were engineered by their very own central banks. And so, an Austrian's view the unsustainable booms in the economy that the central banks create, those things necessitate economic crises, recessions, that sort of thing, with high rates of unemployment. So, my book shows 100 years of evidence where the Keynesians have consistently gotten it wrong. So virtually for their entire existence, Keynesians have been getting that wrong, and yet they are in power because they analyze things and recommend things that the politicians like to hear. And politicians don't like to hear what Austrians recommend, which is sound money and balanced budgets and low taxation, no government intervention in the economy. And so we're very much out of vogue, out of style amongst politicians. Now, regular people out there, they like what we have to say. They think it's just common sense. So it's a completely different view of how the economy works. And it recommends a completely different economic paradigm for government. And, and that's why it's in control. And hopefully in this cycle of investment mistakes and government mistakes and, economic crises to follow, 50% of the American population and the European population is already in a recession. And the same is true probably for Japan as well. But it hasn't hit home because it hasn't hit the political class, and it hasn't impacted the power elite, because the power elite are the ones that are benefiting from all this. The power elite, in terms of economic inequality, which is also driven by central bank policy, because when you cut interest rates, you raise the price of assets and you make credit available at low rates. And it's the power elite, the wealthy classes, that already have wealth, and they can take advantage of leveraging. And so they're very much benefited by this. And, there's a lot of talk right now about how Christmas sales in the United States and Canada are going to be driven almost entirely by the top 10% of income earners, basically, in North America. So, it's that kind of thing, and nobody realizes this. And as a matter of fact, a lot of people who are familiar with Austrian economics don't really recognize that third part of central bank inflation is that it causes economic inequality because it favors the people with wealth, and it favors them because they can get levered up based on low interest rates. But the working class, all as they get is higher prices. So they're disadvantaged in the process. And so, I think more and more people are waking up to that, especially the people who find themselves at a disadvantage. And I'm hoping that they are going to make the difference as we look at the next round of political reforms in the future.
Mark, you outlined some incredibly interesting things there. And of course, what isn't commonly known, central banks haven't been around forever. They're a relatively new invention, and inflation, a consistent inflation rate, is definitely a very new concept. The Federal Reserve has recently reintroduced this concept of FATE, which stands for Flexible Average Inflation Targeting, a more longer-term target for inflation. Do you think this is a sort of admittance that the genie is out of the bag on the inflation side?
Oh, definitely. This is an age-old ploy. If things aren't looking well right now, you just project into the future that they're going to look better in the future, and therefore we can take an average of that and say, well, things are not looking great right now, but they're going to look even better in the future, so we'll average that, and things are not so bad. I mean, right now in the UK, for example, they're going through a political upheaval and a budgetary upheaval, and the socialists want to spend more money, but they know they can't get away with taxes and levies and that sort of thing. So what they're saying was, well, we'll levy the taxes in the future, we'll spend the money now, and hoping not to spook the government bond market. By saying that on average they're moving towards a balanced budget and a sound financial system, but that's the biggest lie in the book, basically, of promising to do better in the future. You're being bad in the present, and you're asking for more candy or more money or more something, and you promise to be better in the future. And really, I don't see that as convincing markets, especially the government bond markets and currency markets, and the overall economy, the productive class. I don't think the productive classes are going to buy that kind of story anymore. And so I think the Fed promising that things are going to work out in the long run, I don't really see people buying into that. I think that's just window dressing on their part and something to tell the media to try to fend off opposition and to try to fend off further attacks on its legitimacy.
I would love to talk about silver for a second, Mark. When one looks at a chart for silver, inflation adjusted, it looks incredibly cheap. Even gold adjusted, gold to silver ratio, it looks incredibly cheap. Is that a fair comparison to make? Is silver still a monetary metal?
Oh, yes. Silver is still a monetary metal. More than 50% of silver consumption is for some kind of investment purpose, and it's about 50-50 between industrial, where it's going to be used up and consumed, and 50% is going to be for an ongoing holding. So investment purposes, silverware, jewelry, that sort of thing. And I think silver is still certainly, it's always been a monetary metal, and the French word for money is silver. So, I think historically that's the case. And I think it lost some of its monetary reputation in recent decades because the price has been lagging, gold price, and we only recently returned to the historic high levels of $50 an ounce in silver, which was, occurred in 2011 and 1980. And so people view it as, is a very, something that's lost its monetary character, but it has gained more of an industrial character. But I've written about this and has been speaking about this, about the unique features of the silver market in terms of supply and demand. And, in terms of supply, most silver that comes to the market is the result of byproduct production. So it's not silver mines that are bringing it to the marketplace. It's gold mines, copper mines, zinc mines, lead mines, those kind of things that are bringing 70% or so of silver to market. And there was a big push up in the early 2000s in the form of the housing bubble in the United States, global real estate bubble, global infrastructure bubble in places like China, in places like India. And so there was a whole lot more metals being consumed like lead and zinc. Those are more infrastructure metals used in construction and infrastructure. And as a consequence, those mines were producing an extra amount of silver into the market. And so what we saw was historically low silver prices relative to gold and relative to consumer prices and everything else. And so there was a period of market price suppression of silver. But now in recent years, of course, we've seen those low prices really cause a stimulus to industrial demand for silver. So as particularly environmentally with solar panels and electric vehicles and batteries, windmills, all sorts of things have expanded the industrial demand for silver. But let's look forward into the future. And, if the Fed is creating a bubble in things like artificial intelligence and technology, and if it's global and if there is a crash or there is a crisis, then lead mining and zinc mining and things like that are going to suffer. Lead mines and zinc mines and nickel mines may shut down around the globe, and as a result, that silver production that was in excess of some kind of average is now going to be a deficit in a crisis economy, global economy. And so even if silver prices are rising, we may actually get less silver coming to market. So it's a kind of a counterintuitive situation. And we might see that, silver prices really rise significantly. And that's another thing I've been talking about is the gold-silver price ratio. I did a podcast of my own on the gold-silver ratio when it was over 100. And I talked about some of these issues and the fact that I thought, well, as the precious metal market expands, silver is going to do relatively well. And as we speak today, the gold-silver price ratio is now less than 80. So there's been a big move in that ratio, and more attention is going on to the silver market and the price of silver. And of course, today with the CME, experiencing a mysterious shutdown, just as silver was about ready to hit a new all-time record high. I think, the conversation going forward over the next couple of years, we're going to see that the monetary status of silver is going to be restored in our thinking.
A mysterious shutdown just as we might be hitting new all-time highs for silver. It's an argument we hear a lot about silver, that the price is being manipulated. Do you think there's any validity to these claims?
Well, yes, and I've been thinking about this a lot, and it had a lot to do with my thinking about what I mentioned earlier about growing pains in the market, because the silver market at the wholesale level is really held by a small number of people in the banks that are involved in bringing silver to market. And, as part of that process, of course, they're writing futures contracts. They're selling silver into the future as part of their normal business. Now, of course, if that's part of your normal business and it's a small number of players, well, yes, that's, it opens up possibilities for manipulation. And I think it, like any market, people are looking to manipulate prices if they have an opportunity to do so. And I think in the old silver market that I'm referring to, I think that was a possibility where you can see manipulation, at least in the short run. I think that the big effect that I just discussed about silver byproduct production is responsible for much of what people think of as manipulation, because we saw, all this extra silver coming into the market, and what might happen in the future is a deficit coming from that byproduct production. But in the short run, with a small number of hands into the marketplace being responsible for selling mining production into the future, I think that I think that there is a possibility of manipulating prices. It's not something that I worry about too much, but I think it certainly could take place and probably did take place. And the fact that people have been prosecuted for it is certainly evidence that it was a factor in markets and probably disadvantaged certain players in the market as well. So, and I think that the fact that, I see this as we were talking about just recently, the fact that I think the market is going to evolve as Asia gets much more involved and is much more an independent player. I mean, they're responsible for a large amount of the mining. They're responsible for a huge amount of the refining, and they want to use gold and silver, the BRICS countries do, to open up the whole world economy away from dollar denomination, where the Chinese yuan and other currencies play a role. So I see this whole thing as changing, evolving, and it's going to be very interesting, but predicting when and exactly what's going to happen is beyond my pay level.
All right. I recently had a chat with Francis Hunt from the Market Sniper, and he outlined something interesting about platinum. Of course, a significantly shorter history than silver and gold because we weren't able to mine it historically as a species. He argues it's a monetary metal as well, with actually incredibly few ounces in the Earth's crust. Is this something that's on your radar, platinum?
Well, it is a much smaller marketplace and a much smaller amount of production, but it is certainly precious. So it certainly fits the category of being a precious metal, but I don't think, strictly speaking, that it's a monetary metal in the sense that it's ever really served as money, and that it's unlikely to serve as much in terms of a commodity money future. But it's certainly, given its very small size and given its incredible industrial applications, and given the political instability in the countries where it's mostly produced, it's also going to be very interesting and possibly explosive, because the price there has been historically relatively low now relative to gold. So we could see big explosions in the price of the platinum group metals, I think. But it seems to me that they're too small and have no historical record with respect to uses as a medium of exchange or a monetary metal. So in my own mind, I keep the definition of precious separate from the definition of monetary metals. But for investment purposes, I think they're all sort of in the same category.
Incredibly interesting distinction there. I would love to talk. You referenced earlier a bubble that you're seeing in AI, artificial intelligence, and I think this bubble in government debt is also well understood, or at least well discussed. Something that's a bit less discussed is a potential bubble in private equity. Do you think this could potentially be a type of black swan or gray swan event that could, take us out while we're not looking at it?
Yes. I recently went to a family event, 6 hours there and 6 hours back. I was listening to Bloomberg the entire way, and every guest they had on denied that there was an artificial intelligence bubble or that there was any contagion possible in the economy. And somehow that uniform answer did not make me feel much better. They were basically talking their book and the Bloomberg storyline. I think that at least people now recognize the artificial intelligence bubble just because it shows so many classic signs of the Austrian business cycle theory and the previous tech bubble where companies were intermingling their sales and their borrowings and they were having trouble building facilities and building up production. We're seeing the same signs there. So it's much more obvious. Now with private equity, there's very little discussion of that. It's very much, there's no publicly available data that's regularly transmitted to the population about that. I mean, it's when you're taking publicly held companies' assets and capital and you're moving them off of the public shelf and into private, darker areas where even the investors don't really have a good handle on what's going on because they don't get that daily price fix. And so I'm certainly concerned about the artificial intelligence bubble, but I'm also concerned with the private equity bubble situation because it is, a case where the information about the assets is not publicly available. So it would be more akin to the mortgage-backed securities, the collateralized debt obligations, those kind of things in the housing bubble where people did not, they weren't getting that daily fix of market-determined information, and the problem was allowed to grow undetected, basically, except by a very small number of people until it was far too late to do anything about it. So those are, I think, two currently coexisting bubbles, but they have completely different characters now that the AI bubble has received much more public attention, I think, as a result of the similarities to previous bubbles, the tech bubble specifically. But I think so I think that's important. That's an important distinction to be made between the two. With the Fed creating low interest rates, it's really creating unsustainable balance sheets and financial obligations throughout the economy. So it's impacting all consumers, all companies, too much investment, too long-term investment orientations. It's doing this throughout. So picking the black swan that's going to first emerge and pop the overall bubble is really hard to determine, when in fact you've got bubble conditions throughout the economy. Consumers have too much debt, businesses have too much debt, AI and technology has been investing, for very long period, for long time horizons. You've got the government debt bubble. These things are all happening simultaneously. Private equity, it's all very massive. And the black swan is simply the one that emerges that causes contagion through all the rest of those bubbles. And so my podcast tomorrow on minor issues is about this denial of contagion in the economy that all the guests on Bloomberg were so adamant about. Oh, no, there's no contagion. I'm very well diversified, So, but in fact, the Fed is creating this contagion automatically throughout the entire economy.
Mark, there's almost this feeling in the market. Everyone is conditioned to buy the dip. If there's any sign of any economic weakness, the money printers will just start burring, and the money helicopters will fly in and save the day. There's this feel that there almost cannot no longer be a substantial pullback in equities or a serious long-term recession in nominal terms. Do you think we'll ever see a serious long-term recession again in nominal terms?
Yes, I think buying the dips is a logical investment strategy in a free market economy. I think it's a logical strategy in an economy where the Fed is backing the stock market, and particularly in recent years, where if anything went wrong, the Fed has just come to the rescue of the stock market. They would deny that, of course, but if you look at a timeline of their maneuvers in the stock market, you see it's very highly coordinated. Where the Fed is coming to the rescue, and a lot of it gets very little press about how they're rigging markets, because they only have one tool, which is to print money, but nowadays, they can do a lot of different things in terms of their balance sheet and reverse repos and, things that we've seen just in the last couple of weeks that don't get any real reporting. But eventually that comes to an end. The Fed is not all powerful. It's not infallible. It makes mistakes all the time. And eventually there's a market realization that, hey, this thing can't go on. The party has to stop. It's not so much a decision as it's a reality check. And that's what I was speaking about earlier about the government bonds in Japan, the UK, the United States, and elsewhere. It's a very intricate web of deceit, essentially, that the Fed has been layering on here. I think that we've had the possibility of a crash in the economy since 2018, 2019. I was expecting a severe retrenchment in the economy in 2022 when COVID arrived and bailed out the whole process. The Fed printed up $5 trillion of backing for the economy and set us off on this next cycle, upcycle. So they can do that. It does work sometimes in the short run where they can extend the bubble, but it's not infinite. It's not an infinite power. I mean, they will, when the stock market gets into a correction, they will continue to cut interest rates. But we've also seen in the past like with the tech bubble that I mentioned earlier. The Fed was right in support of the tech bubble, and they saw the tech bubble in 2000 starting to break down, and they started to cut interest rates, and it didn't make any difference. The tech stocks just completely melted down. They lost more than 80% of their value, and all of those rate cuts by the Fed were not able to bail out the system, and the same thing happened with the housing bubble. The Fed came in with 100 different programs to bail out the financial angle in the economy, and we ended up in the Great Recession. But with COVID, they were able to get away with it. But it's not an infinite power, and eventually it breaks. It's not just a mistake or the failure of nerve or the failure of whatever. It'll come to an end.
It will come to an end. Mark, for anyone still with us, perhaps can you talk for a second about the podcast that you do and talk about the Mises Institute for a second?
Yeah, I'm here at the Mises Institute, and we're the bedrock of the study of Austrian economics and the economy, and our main goal is to teach people about Austrian economics for students, graduate students, professors, and the general public. And as a matter of fact, we're offering a free book of Friedrich Hayek's greatest hits articles, some of his classic articles that he's known for, including, he was the guy who sort of came up with the idea for Bitcoin or cryptocurrencies back a long time ago. And he was really the ideological backbone for fighting inflation in the 1970s, and the ideological backbone monetarily for things like Ronald Reagan and Margaret Thatcher. And so these are all accessible, readable, and very influential articles, but they really teach us a lot about the economy and government and politicians, why the worst always get to the top. So, I would very much encourage everybody to get a copy and read this book. If you leave me a comment in the show, I'll send you the link so you can get a free copy of the book or free copies of the book.
Dr. Mark Thornton, it was a true pleasure to have this chat with you. Incredibly enlightening.
Thank you. I enjoyed it tremendously.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.